Good afternoon, and welcome to Cracking the Currency Code, the science behind creating an effective currency hedging policy. My name is Simon Miles. I'm going to be your moderator for today's session. We've got Harry Mills, the founder and CEO of Oku Markets, who's going to be presenting to you. So, welcome everybody. Just some housekeeping to get us going. Could somebody let me know that they can hear me and just give me a little hands up just so that I know that I can be heard. You have any questions? So he's entitled here, the science behind creating an effective currency hedging policy. Some of this stuff is particularly scientific. There may well be questions. I'm sure people will have questions. We're just going to take a few minutes to let everyone join. We've got as many people here for the beginning as we can. But if you have a question at any point during this webcast, please drop it into the chat and we will do our best to answer it in real time. Find Harry on LinkedIn at LinkedIn // Harry Mills. Harry's email is harry@okumarkets.com. If you've got any questions, if you've got anything you were stuck on, there's going to be a few giveaways, a few bits to follow up with. Also, mention again at the end, we have part 2, which is now posted on LinkedIn. We're going to do this in 2 sessions. There's an awful lot of content, and we're going to be going through a number of the agenda items today, but there will be follow-up. There's going to be follow-up in the next session. So just going to give it another kind of 30 seconds because you know what it's like, particularly if people are working at home, the door's just gone, the Amazon driver's come at the wrong time and the dog started barking. So give it a few minutes, well, not a few minutes, a few seconds, and we will get underway. Okay, well, let's get started. So, as I said, if you have any questions, please put in the chat. Anything that you want to ask, please feel free. We'll do this. We've got a couple of questions that have been emailed through already, so we will hopefully get to address those towards the end. But we're going to be about 40 minutes longer. I think concentration span lasts that long, according to my understanding. But we will do our best to keep this interesting, keep this lively, and make it relevant. So, over the course of the next 30 minutes or so, probably 40 minutes, we're going to be exploring the science behind calculating your FX exposure. We're going to be looking at what is a hedge? It might not actually be what you think it is. Calculating FX risk. This is where we're going to give you the scientific tools, the models that we use to calculate currency risk. And then we're going to get on to designing a hedging strategy. There's going to be a number of examples, different types of hedging strategies, and the key things that you need to know to design a strategy. So, first, I am going to introduce you to Harry. Harry's the CEO and founder of Oku Markets, and also really the brainchild behind a lot of this science that Oku Markets do very differently to a number of other providers in terms of actually providing you with a quantifiable hedging strategy that makes sense and hopefully stabilizes your foreign exchange exposure. So, Harry, over to you to introduce yourself.
Yep. Good afternoon. Thanks, Simon. As Simon mentioned, please look me up on LinkedIn if we're not already connected. I think I'm connected to most people that I can see popping up. And please send me an email, harry@okumarkets.com, and I'll send you a copy of our business managing currency risk PDF. And again, we'll be doing the follow-up to this session in 3 or 4 weeks' time. The event's already live on LinkedIn. And it really is a follow-on because today, whilst we'll be going through how to calculate your risk and how to design a strategy, in the follow-on session, we'll be running through how to test it and how to manage the performance and then how to write the policy on the back of it.
Brilliant. Okay, cool, Harry. Well, look, let's start with the basics. I think this is a good one because a lot of people think the true definition of what hedge is vital to this session. So, tell it, what is a hedge, Harry?
Yeah, so it might sound obvious, but a financial instrument is only a hedge if it offsets potential losses. So there needs to be an underlying exposure there, which might be a committed or a forecasted cash flow. It could be an overseas asset or a liability, or perhaps an investment portfolio. if you buy a forward contract or a currency option or any kind of financial derivative, if there's no underlying exposure, then it can be a binary bet. It can be speculation. So again, might sound obvious, but it's a hedge is only a hedge when it's there to mitigate potential losses. On the screen there, I've given an example. Let's take a really straightforward one. UK firm importing from Germany, exposed to the value of the pound against the euro. So we've got the green line is the underlying exposure. So as the pound appreciates against the euro, the underlying cost of purchasing the gear, whatever it is from Germany, reduces. So there's a positive P&L. If conversely, if the market falls, if the pound depreciates, then of course it costs more. There's a negative P&L. We hedge that by selling sterling forward with a forward contract or an option or something else. And the net result is this offset. So we have this clean zero P&L net result. So that is what a hedge is, and maybe what a hedge isn't. But in addition to that, a spot contract, right, could also be a hedge. So we often think about forwards. So we think about 3, 6, 9, and 12-month trades. But if your timelines in your business are short term, if you're a commodity trader with a 1 or 2 day delivery, then you will hedge that risk with a spot trade. But before you do any kind of financial instruments, you need to think about whether you can net, match, or shift the risk on. So that's our mentality here at Oku Markets, is to, before you enter into any derivative trades, is there an opportunity to offset that risk without actually buying any contracts altogether?
Super. Okay, so that's the basics. What is a hedge? So now we know what that is, and I spent a lot of time in foreign exchange deliverables and talking to a lot of customers, a lot of corporate clients over the years, and often the question will come up. It is kind of like, why should I even bother? Now, risk mitigation is, but when should a business bother, Harry? And, it's the question quite a lot.
Yeah. So should I even bother hedging? So some businesses should, some businesses shouldn't, and we actively tell firms not to enter into forward contracts if it's not right for their business. So the 4 questions that you should ask yourself to find out whether you should take the next step are as follows. 1, of course, is there an underlying exposure? Does that exist? So everyone on this call, if you work for a business where you import or you export your services or your products, you will know there's an underlying exposure. Then is it worth hedging? Is the risk material? So if you're a £100 million business and you happen to buy your paper clips, right, from Ireland, 5,000 euros worth a year, that's probably not really a risk worth hedging. And then is it possible and practical to hedge? So if you're dealing in thinly traded currencies, so maybe some Central African currencies or restricted currencies, it might not even be possible or practical to forward hedge that. So you have to think of other ways to reduce your exposure. And then what's the cost of hedging? There's some flags there of some countries that you recognize the currencies, I'm sure, of being quite volatile or of moving in large directional swings in the last year or two. Perhaps the cost of those hedges would be prohibitively expensive. So again, think about a different way of reducing your exposure to those currencies. And as I mentioned earlier, before you do so, can you shift the risk to somebody else? Can you match your cash flows internally or within the group, or net them within the group?
Again, another thing as well, Harry, is interest rate differential, right? So that might weigh against you if you're buying certain currencies, but of course, if you're buying other currencies, the interest rate differential is above that of the base currency. You might find that it's actually beneficial to hedge forward because you're reducing the cost.
Yep, exactly. So that's the cost of hedging piece, is the relationship between the interest rates of the 2 currencies you're dealing in. But this stuff isn't static, right? It changes over time. So we advise our clients on the best ways of hedging on a continual basis and on an ongoing basis, because the picture changes. Anyone importing to buy dollars, buying dollars to import, will know how the forward points have changed over the last year, swinging between positive and negative for sterling against the dollar. So again, we give that advice as well. It's worth noting for sure.
Super. Okay, so now we've got the should I, shouldn't piece and reasons for and against there. Let's get into the nuts and bolts. So how do we calculate currency risk? I mean, probably best to start with definition, I would expect, because again, it's one of those things, as soon as when you understand the definition, you get further clarity.
Yeah, so I like the ISO definition of risk in general as the effect of uncertainty on objectives. And if we were to define FX risk, well, we just tie that into, it's the same thing, but tied into exchange rate fluctuations or currency volatility. I think most people intuitively think about their source of their risk. So, I buy euros, I sell dollars, and that's not their risk. It's the impact of the risk. And I think it pays in the business world to contextualize it in terms of their business objectives. So whether you've got particular growth plans or payment of a dividend or M&A plans, even things like staff retention, share of the market, all of these facets of business are directly impacted by exchange rate fluctuations, and they should be factored into defining your currency risk. And when it comes to the actual numbers, calculating it, well, in my 12, 13 years doing this, I've only come across a handful of companies that can actually articulate their risk. So that would be the first question to the audience is, do you know what your currency risk is right now? And I don't think a high number would put their hands up for that.
And it's real time, right? It's getting in on that morning when something's happened overnight. I mean, I remember Brexit being the biggest one of that. And it wasn't so much where the market's going to go, it's what it actually meant as a result of that huge anomaly that had happened in the markets. And whilst there's not another Brexit around the corner, there's interest rate movements and economic conditions, a war in Ukraine. There are things that could materially affect the currency markets instantly overnight. And it's kind of, what are you doing to prepare for these anomalies that could strike out of the blue? So how does a business articulate their currency risk then? How do we actually calculate it, Harry?
So if you're going to put a number to the risk, then obviously that's what we're here to do today, and we'll show you how to do that. I mentioned earlier about the size of the risk. So the first thing everybody on the call can do is, what is your notional exposure? And is that a big number for your business? Now that doesn't actually give you the impact, so it's not a real risk measure, but it's an intuitive way of saying, should I look at this? I like looking at market-based metrics as well as an initial viewpoint. So this is market volatility. This is the trading range, high-low range of the currencies you're dealing in over a 1, 2, 5, 10-year horizon. That gives you a good idea of whether you're dealing in a currency that is volatile, does move a lot, or one that doesn't. So again, if you're buying from Turkey in Turkish lira, then you'll understand that that's a higher volatility currency than, say, Euro Swiss has historically been, bar the time the Swiss National Bank decided to remove the peg, but that's beside the point. And then from there, in terms of actual quantifiable numbers, we're going to look at stress testing today. So this will give you a P&L impact for various market movements of intervals of, say, 5, 10, and 20 plus and minus percentage market movements. And then value at risk. We'll look at this in a few minutes' time. This is the number one risk measure from the investment world that we bring to our clients. And then you can use Monte Carlo simulation, this forward-looking sort of random walk style approach where we say, where might the market go? And then back testing to say, how would our positions have looked in previous years? So all of these elements together are almost like the risk toolkit for calculating risk. But for me and for our approach, it's the stress testing and the value at risk that gives you those numbers that you can take to the boardroom table and say, this is our risk level.
I love that Monte Carlo. What's the actual definition of that, Harry? It's a number of notional scenarios, isn't it? Playing out.
It's scenarios.
You map out.
Yeah, you map out the scenarios and adjust variables over time. So on the screen there, we can see some random walk analysis we did for some of our clients a little while ago. We're building that model out into our process. So yeah, it's quite good fun. Good name as well.
Cool. Well, let's have a look at stress testing then. Can we have a look at an example of it?
Yep. So we've got a live example of some stress testing. So this is a Google Sheets linked to live spot rates. So let's stick with sterling euro, our UK firm buying from Germany.
You might want to just zoom in on that a little bit, Harry.
Just zoom in. Yep. There we are.
Just a tiny bit.
How's that for you?
Yeah.
Lovely. So we're selling the pound, buying the euro, and let's say we're 12 million euros a year. And there's our current spot, 117.31. And we've budgeted at 115 for this fiscal year, for example. Well, straight away, this stress testing tool will give us our plus and minus 5, 10, and 20% P&L impacts for those percentage movements. And we can see it on the chart as well with a greater degree of quality. But a 5% movement on this particular business's portfolio represents a 330k impact to their P&L. That may or may not be a large number. If the net assets of the business is 3 million, well, that's 10%, right? So that requires some mitigation, I'm sure. But this is a technique that we do for our clients, and that everybody on this call should be able to do after this. And I'm very happy to provide this sheet to anybody who wants to email and get in touch to take it.
Cool. And just on that note, actually, Harry, just a reminder, guys, if you've got any questions, put them in the chat, because we're kind of whistling through this in 40 minutes. There may well be things that you want to come back to. And you can email Harry as well at harry@okumarkets.com, or put the questions in the chat for the end. So, using value risk, you mentioned that was your favorite aspect of it, the most important parameter. Do you want to start telling us about that before we get into the science of how we're pulling all this together?
Yeah, so going to value at risk. So it's a highly transferable single number measure for risk, and we like it because it's transferable, it's statistical, it's not just a hypothetical what if the market moved here. We like it because non-financial executives can understand it very easily. You can, with a little bit of training, you can say this is our risk number, and everyone around the boardroom table can understand it. There are some limitations, which I'll come on to, but to give you a definition of what it is and what it attempts to do is it quantifies the maximum probable loss for a specific confidence level. So the limitation is it's not the maximum potential loss altogether, it's at a certain confidence level. So on the graphic, we can see 95% confidence. So if we've got a portfolio, let's say the $12 million portfolio, for example, as I had on the screen earlier, or euros, if the value at risk was £250,000, then across a 3-month horizon, that tells us that 95 times out of 100, the maximum risk loss will be £250,000 in that 3-month period. Does mean, though, that there's a 5% chance of a far greater loss. And that's where you need to do the stress testing as well to say how big could that loss get. So with the VAR, and we've got a demo to do, but it's critical you think about the time frame that's relevant to your business, the notional exposure, and then what's a big or small value at risk really is relative to your company. So it's all about context. And that 95% confidence piece, well, 90, 95, and 99 are the industry sort of standard confidence levels. So I'd use those. We use 95 and 99, and then set a target for yourself. So do your risk level first. What is my inherent risk, my inherent value at risk? Maybe that's £500,000, and then set yourself a target, and that's where your hedging plan needs to bring you to.
You know what? You walked over something there. You said it really quickly, but I'm going to bring you back to it because I think it's absolutely critical. And I always use the example of Brexit because Brexit was the biggest anomaly we've seen almost generationally. I mean, we went to sleep with the dollar at 151 and everyone woke up with it at 136. And then within another 72 hours, it's touching 128. So if you're a buyer of dollars and you're sitting comfortably that we're going to vote to stay, it changed dramatically in about an 8-hour period. And you use the term, the board can be aware. And I think that's critical because that accountability piece, when you've got a hedging policy, a document, a strategy that everyone's signed off on that you can follow, that's calculated, that's not finger in the air. It means, and I saw this actually play out where financial decision makers weren't the first in the office in the morning. They couldn't be got hold of and nobody knew what to do.
Yeah.
And yet, if you've got a policy, it's been signed off, you take accountability away from one individual decision maker, and it's normally the financial decision maker. And you spread that out so that the board can look at this document and say, well, it doesn't matter that person isn't here right now. We've got a document here that says at this particular point, we do this. And I think that's absolutely vital here is complete visibility across the executive team of an organization.
Yeah.
So often it lies with one person, right? And I think that accountability is changing and needs to change, really.
Yeah, that shared accountability piece is probably the most important learning for policy creation that we've had since we founded the company. And that the value at risk measure, that one number really, as I said, gives everybody complete visibility for sure.
Super cool. Well, let's get into the magic word science, which is obviously why people are here. They're cracking the currency code and the science behind how we do this. So you mentioned a demo, Harry. Do you want to jump into that?
Yeah. So there's three methods for doing value at risk measurement. There's the historical method, which uses real market data, so real exchange rates, and that's nice because it gives you the jumps, it gives you the kinks, it gives you the volatility, the skew of the actual market. Then there's the parametric method, which uses a normal distribution, or there's a Monte Carlo method as well. We're going to look at the historical method today, which is heavy as it is. So we're going to go through the steps of how to do this. And again, very happy to help anybody after the call if you would like to do this for yourself. So over here on the Google sheet in gray, we've got the steps. So I'll just walk you through the steps. So first thing is we need to obtain some price data. So we're using euro dollar as our example here. So in this table, I've got my daily exchange rates for euro dollar, and I've just taken 2022, so 1 year. Now you could do 5 years or 10 years worth of data to capture more of the way the market moves, and we tend to do 5 years or 10 years. We do 20 as well sometimes, but that captures two or three economic cycles, so it's kind of interesting. So once we've got the price data, we need to take the log returns, and this is pretty straightforward. Just use the log function in Excel or Google Sheets, and you're just going to drag that down. So we're looking at the price change on a daily basis. And at that point, if you're doing it manually, you would order those returns from the smallest to the largest, and you would then look for the 95th percentile, right? You would look for the 95th biggest out of 100, and that would be your cutoff, your confidence level cutoff. So we've chosen 95% as our confidence level. Gladly, we don't need to do any manual ordering here because thankfully Excel and Google Sheets has got this lovely percentile function. So we're just going to use the percentile function to take our confidence level and find out that 95% value at risk score. And it's 1.03% according to this data here. That's nice. That's a 1 day value at risk, but most people on this call are in business, and business tends to operate on a slightly longer time frame. So maybe we want a monthly or an annualized number for the value at risk. So how do we scale for time? Well, quite simply, we just multiply this number by the square root of time. So days, 21 days in a month, trading days, 252 trading days in a year. And there we get our monthly and our annualized value at risk percentage. And then if we just multiply that by our net notional exposure, so net being the value of your net currency flow, so inflows and outflows, there we have our dollar figure. So here we've calculated the 1 month value at risk of a little bit over $500,000 for this particular confidence level of 95%. And that's it. That's as difficult as it needs to be for the historical method.
There's a lot there. I mean, you're doing this every day. I expect a lot of people are looking at this and kind of playing catch up in their own mind. So, before we get on to summarising this, and I think, Harry's mentioned stress testing and value at risk work well together. Before we get on to summarising that's a lot of information. If anyone's on the call who's got Excel spreadsheets coming out of their ears and forecasts, if you wanted Harry to apply the formula to those, please again feel free to reach out. So and we can take you through your own individual calculations before you get to the point where you want to design a strategy, or we can help you with that also. So I think we need a summary at this point, Harry. Do you want to just crack on with that?
Yeah, for sure. Before I do so, I'll just highlight, obviously, we didn't go through the parametric method today, but you can see the equivalent monthly VAR is close, but not the same. That's because here we're using the real market data, and this is a model. But again, I've got the steps here, so if anybody wants to go through that, I can do that with them offline. That's fine. But for sure, it's a lot to take in. So let's look at a bit of a summary. And I mentioned that using one in isolation might not be the best approach. So we use them both together. So why do we do that? Well, value at risk gives you the maximum probable loss for a given time frame with a certain confidence level. So that is statistical. Stress testing gives you a P&L impact for various hypothetical scenarios. Of course, the market doesn't just move down 10% and stay there. So these are your extreme scenarios. So Whereas the value at risk has a limitation that it doesn't show the maximum possible loss because we've got that 5%, it could be greater. The value at risk should show you how bad things could get. The stress testing should show you how bad things could get. So you need to monitor both. So our value at risk is $500,000, but our 10% is 700,000, or 20% is 1.25 million. So that should give you a red light to say, well, let's do something about it. So using them two together is what we generally advise businesses do.
Okay, cool. So we've had two demonstrations of the formulas and the models to calculate. Now, I guess what we need to do is figure out how to mitigate the risk that's associated. So how do we go about designing the actual strategy?
So you now know your risk level. You've calculated your inherent risk. Inherent risk is the level of currency risk before you do anything about it. So before you do any trades, basically. So we now need to figure out, well, how do we mitigate that risk? So the first thing I'll say is there's no shortcut here. There's no copy paste approach. And there's actually lots and lots of inputs that go into how to design an appropriate strategy for your business. And I'll also say at this stage, there is no perfect hedging plan. You need to do as best you can and get going with it, and then you can tweak it with time. So what we're basically trying to come up with is how much should I hedge? How far should I go forward? And how often do I need to be hedging? How often do I need to be trading? And the reason I've highlighted pricing there amongst those 8 or so factors is that it's often overlooked. So if we take a really typical example of an importer that then sells their product in the UK, on one side you've got your cost of goods sold, which is probably fixed in dollars or euros or Swiss or something. But of course, as the rate moves, as the pound moves against that currency, then your actual cost of goods sold in your home currency, your presentation currency, sterling, will change. At the same time, you've got your pricing strategy. It could be that you're in a particularly competitive market and you need to reprice your goods frequently as the market moves. Or maybe you set prices for a long period of time. You've got long-term contracts. So on the one hand, you've got your cost of goods sold moving around all the time because of the FX. On the other hand, you've got your pricing strategy. So it's how to balance the two. And I know that on the call, we've got, by way of an example, I know we've got a couple of financial decision makers from creative agencies that basically export their services to North America and into Asia. And I know that they have long-term renewal cycles for their clients. So they'd probably be hedging quite far out to tie in with those renewals and their various milestones of their projects. Conversely, I know that on the call from the attendees list, we've got some FDs of manufacturers of plastic products and lighting equipment who have a shorter stock cycle and a shorter sales cycle than our friends who have their 12-month, those renewals. So it follows that they'd have a shorter hedging cycle. But again, it depends on your market. So as I said, there's no one way of doing this, and it's through a proper conversation with the stakeholders in the business, procurement, sales, finance, that we get to understand, is 6 months right? Is 9 months right? Is no hedging right? Should you be doing spot trades? So yeah, there's some of the factors anyway, and a couple of examples that I hope helped give some context to it.
I mean, I think I have to say, someone mentioned a question to me only the other day, what are you doing to prepare for what's to come? And it's kind of a what is to come. And I think the uncertainty at the moment is what we're dealing with. I don't think that, the volatility at the moment isn't as extreme as I've seen it before, but certainly the uncertainty. Unfortunately, we're all governed by when we can change our mortgages, right? But if your mortgage, like mine, is coming up in the next 12 months, you're certainly concerned about where interest rates are going to be. And I think it's the same for hedging your cash flow, your current cash flow. It's how can we protect against the uncertainty? Because, frankly, right now, it's the oldest adage in the book, but we've all got the same crystal ball. And I think if anyone was able to tell us where we're going to be in 6 to 12 months' time, they're an incredibly clever individual. On one hand, we've got interest rates capping at 6.5%. Then we've got other people talking about interest rates will need to come down because of possible recession, which is going to gallop up on us. But the long and the short of it is we don't know. So yeah, it's definitely about protection, which I think is very worthwhile. So a lot goes into that. How do you actually bring it together?
Yeah, so once you've got an idea of your inputs and you've spoken
Design
to
a strategy,
stakeholders,
really.
yeah,
The different
designing it.
types.
Once you've understood your inputs and you've taken the qualitative info from colleagues in the business, you then need to figure out, well, how much, how far, how often, and this is where these are our basically like our building blocks, our base hedging programs. And again, there's no one size fits all, but these are our starting blocks. So let's just go through them from start to finish. So back-to-back hedging. You can think of this as a per deal or per sale approach. It removes risk as it originates. And then we've got the static hedging program. Typically, this is a program that ties into a fiscal year. It's a set and forget approach, and it means that you don't have any variance to your budget. You should achieve budget by doing this, but you have the risk of an annual cliff, because each year, as the rate may have moved significantly from last year, then you'll need to rebudget, and that will affect pricing, and that will affect your next year's hedging as well. Rolling is where you maintain a constant hedge ratio over time. So that might be 6 months or 9 or 12 or perhaps even longer. And then at a set interval, maybe it's monthly, you extend your hedge. So if it's 6 months, you take out one initial 6-month hedge, and then every month you tag on another month to maintain that 6 months. And perhaps you do that for 80% of your exposure, or 90 or 50. And that percentage will be determined by the inputs. And then a layered hedging program is somewhat more complex, a little bit more sophisticated, and requires more maintenance. You have to put more thought into it. But it's basically whereby you have higher hedge rates for near dates. So maybe month 1 is 100%, for example, and then lower hedge ratios for far dates. So maybe month 3 is at 50%. So 100% for month 1, 75% for month 2, 50% for month 3. That's quite a short time frame, that 3-month program. So maybe that example business has a 1-month pricing cycle where they adjust their prices, for example. That's why you might do that. Why you would take a layered over rolling is it tends to give you smoother exchange rates over time. But just bear in mind, your hedging process will require a little bit more thought on that monthly or fortnightly basis, whatever your interval is.
So I guess once you kind of decided what you're looking for, the strategy that suits your business and your requirements, the amounts and the time frame, what do you suggest you do next? What's the next steps there?
So next steps to bring it all together and actually come up with the plan that's right for your business is, well, we suggest generating 2 or 3 strategy ideas. And when we do this work for our clients, we'll run 15 plus ideas in the background, and then we'll take A, B, C, or A and B. And you should do the stress testing and the value at risk testing with and without the hedges in place. So that's your inherent risk. So what is my risk level without doing anything? And then if I were to do strategy A or strategy B, how does it affect my risk? That's the residual risk. That's the terminology to use. You could look at back testing. So if I'm going to take strategy A, well, how would that have performed last year? And I'd said this in a client meeting just last week. We can do the quantification work for you. It's the what if is quite important, and that's the qualitative piece. So if we had a year like 2019, for example, and we did strategy A and the market did this or that, how would we have reacted? Would we have been able to put off a price increase, which may have hampered our relationship with our customers, for example? So those what if scenarios, it's a good thought experiment. You might do some forward testing with the Monte Carlo simulations, but for sure you should build out the strategy guide like we've got on the screen there as an example of the work that we do. So we'll put together, this is an example of an A versus B strategy for a board to decide upon, where we lay it out visually and with all the relevant numbers of how they would work with different scenarios. Once it's decided, work that into a formal policy document which shares accountability. You get the board to approve the policy, and that then steps down for the finance team to execute against. So they've got a very clear mandate. Accountability shared, and they know when to trade, how to trade, why, what we're trying to achieve. And there's no one person solely accountable. You can't get it wrong. You're going by the policy. So that's how I bring it all together.
Okay, right. We have got 5 or so minutes left now. I've got some questions over email here, Harry. I don't know if you've got any questions on the chat. I can't see this with the questions on the chat so I wouldn't know. But if there are any questions in there that you wanted to address, let me know. I have a couple of questions here on email from Sarah and David. I don't know if they're on the call, but they sent them through earlier. I'm just going to put them out there, I think. Have you got any there live, Harry?
Not live, but happy to take those too.
Happy to take them as well if you want to put them in there. But we've got one here from David. What are your thoughts on currency options versus hedging?
Okay, yeah, I mean, that's a pretty big one. So I've got a lot of experience with currency options. I've been advising on and trading them for best part of a decade. Look, they can be incredibly powerful, incredibly useful tools if used correctly, and as part of a risk management strategy that makes sense for the business. I think that the term option is often used as a sort of a catch-all for a whole host of multi-leg, structured, exotic products that are sold in the market. So, they can have really interesting and really valuable and positive payoffs for business clients. They can also have quite nice payoffs for brokers selling them, by the way. But if David's got more questions on that, then I'll be very happy to take it offline because for sure that's one of the services we offer is to look at those sorts of products and to price check them and to give our thoughts and recommendations on it. So yeah.
Okay, cool. And one other question I've got here is, can I use two strategies at the same time?
Yep, absolutely. So we've got a number of clients who use two strategies concurrently, and you would do that if, for example, you've got different types of customers in your business. So I mentioned the creative agencies earlier. So for whatever reason, we work with a number of creative agencies, and they tend to have fixed renewal business. So that lends itself to a rolling or a static hedging program. And then your ad hoc business, these projects that just pop up out of nowhere almost, so it seems, you would back-to-back hedge those. So absolutely, it makes sense to split up those sorts of business if you can. And again, it sounds complex, but it needn't be. Our idea and my ethos for this sort of work is that the currency hedging becomes a 10-minute thought process on a monthly basis or a fortnightly basis where you aggregate up your positions and then you simply hedge against the policy you've already got in place. So it's almost like you make one set of decisions at the outset and then you just get on with it. You don't need to worry about the market. So whoever asked that question, yes, you can use two strategies at the same time if it fits in with your particular business. Yeah, definitely advocate that for sure.
Brilliant. Okay, so just before you get on to telling us what we're going to do next time, so we have Cracking the Currency Code Part 2 coming up in the next few weeks. We'll send the link to everyone who attended today, and it'll also be on LinkedIn as a new event. I think it's either the 27th or the 28th of July, so not too far away, because I think it's important to keep momentum up if any of this resonates with you. We've obviously covered what is a hedge today, what is risk, considering the impact and the context of that. Should I even hedge? The 4 questions before proceeding. How to calculate FX risk, inherent and residual, and that's kind of where the numbers came in, and value at risk, your new FX risk management benchmark. Those 2 pieces there, obviously, were the science in this half of Cracking the Currency Code. If you want any further information on that, or perhaps if you wanted to pump in your own cash flow forecasts to it and work out what your own FX risk, your own inherent and residual risk was, or what your value at risk is, the most important number, then drop us an email. Again, I'll just tell you that it's harry@okumarkets.com. And then we kind of got into designing a strategy by how much, how far, and how often. And so before we end, Harry, and I'm going to sign off at this point and say thank you very much, but I'm going to leave Harry to close the webcast. Do you want to tell us what we're going to be covering next time, Harry?
Yeah, so the whole point of this session was to go through how do I calculate my currency risk. And the reason we did this is because pretty much everyone we speak to doesn't know how to do it. So hopefully, if you're on the call, you now have the tools to do that. At least you've seen how to do it and you can come and ask me to give you some hands-on help. I'll be very happy to do so. That's all well and good. You've got the strategy, but how do we review the performance? How do we test it? So on the next session, we'll be taking you through that, how to test a strategy, how to review performance, and then also what goes into a policy, that formal document. So we'll take you through that process
What's the
as well.
benefit of having that formal document, Harry? Just before we end, what's in your opinion the main benefit of having a formal document? Because I think a lot of people would say they might have a hedging strategy, but it's in their heads and it's kind of on an Excel spreadsheet. Well, why would I have a formal document?
Formal document, well, it aids decision making. You know, my two biggest learnings over the past year or so have been about delivering the ability to make better decisions for financial decision makers and business leaders, and sharing accountability. You know, I'm sure everyone on this call, you probably have a little chuckle to yourself. You will know someone in your business who has a strong view on the market, right? They're a bit of a Gordon Gekko, and they think they've got a feel for the market. Well, having a formal policy in place completely insulates the business from probably quite bad decision making. So shared accountability and better decision making. That's why you should have a policy in place. And it doesn't need to be war and peace. You know, we write these for businesses all the time. They can be 8 pages, 10 pages, or 2 pages, depending on what your needs are and how complex and sophisticated things need to be.
Brilliant. Harry, thank you very much. I think that's been excellent. I hope everyone on the call has got value out of that. Harry, I'll leave you to say farewell.
Yeah, thanks, Simon, for hosting. And thanks, everyone, for joining. Really appreciate it. Hopefully you find it useful. Please do give me a call. That's my direct dial. You've got my email there as well. And hook me up on LinkedIn. If anything of today was confusing or you want to know more, you know, just reach out. Be really happy to help. And please join the next one as well. Thanks so much. Take care.
Cheers. Thank you. All the best.